Good morning, everybody. This is Kathy Elkins with Premier Marketing. Thank you for joining us today. I have David Neal on the phone with me from Mutual of Omaha. Good morning, David. How are you doing?
Good morning, Kathy and everyone else. I'm doing great. Thanks. I appreciate this opportunity.
Wonderful. Hey, everybody. David is our broker sales director from Mutual of Omaha, United of Omaha. He's got a lot of great information on a product that I asked him to talk about. It's our Life Protection Advantage IUL. I call it a GIUL, and when we get into this, you'll understand why. But David, go ahead and share with us this wonderful product that I like so much. And I'm hoping that the agents online will start using this product.
Okay, great. Well, thanks, Kathy, and thanks again for everybody. I know everybody's busy, and some of us have webinar fatigue, but hopefully this will be information that's helpful to you. And this is scheduled, I think, Kathy, for an hour. And you know what? The good news, at least I think, is I'm gonna give you some good information today, but it certainly won't take an hour. It may not even take a half hour. And so I will be talking about one of our fully underwritten indexed universal life policies, IUL policies. I'll lead with that because that's what Kathy wanted me to talk about it, and it's a great product. But I also touch a little bit on our other fully underwritten IUL product, and then we also have a Express or simplified issue IUL, but I won't be speaking about that today. So just know we're going to be kind of concentrating on this one product, but in total we have 3 IUL products. So we've got you covered in terms of IUL business. And as Kathy knows, I always like to kind of start a little bit to level set the stage. I'm not sure, obviously, with whatever size audience we have, how familiar all of you are or aren't with Mutual of Omaha, and who we are. And I just want you to feel this is not meant to be a company commercial, but just learn a little bit or know a little bit about us more in terms of, and have some confidence in who we are. Of course, most everybody knows us. We have very good brand recognition, name recognition. We've been strong, stable for over 100 years. Great dedicated team of support. Not just myself, of course, but all of the support we have at the home office, and you've got the great folks there, Kathy, and everybody else there at Premier. This slide says competitive simplified issue product portfolio. That is true. We're not touching on that today. We're going to be looking at our fully underwritten portfolio today. And then just a quick shot at our current ratings, very high ratings across the top from the top 3 rating agencies. So, you should have a great deal of confidence, if you don't already, with Mutual of Omaha in terms of who we are and our overall financial stability, et cetera. So if I think about our IUL story, and this is true for all 3 of our IUL products, including the one we're going to talk about now, is we favor and very purposely follow a very simple, low-cost IUL story. And there's really great benefit to that, I think, because an IUL policy does have quite a few moving parts, certainly as compared to a term product or a whole life product. But as I always say, there's more moving parts, but that's a good thing, not a bad thing. It's just that if you're new to IUL and your clients have never seen one or contemplated buying one, there's just a little bit more to talk about. But again, those things you'll talk about are very favorable in terms of the flexibility of the product. So we really like to follow that simple design. The industry, and you folks probably know this, is IUL is the largest fastest growing segment of the life insurance industry. And there's a lot of great companies out there with very competitive products, but a lot of them are very complicated in their design. I would say, in my opinion, for what it's worth, unnecessarily complicated with, multiple indices and multipliers and all sorts of stuff that, I tell you what, would make it hard for me to explain to a client. So we have a very competitive product, but it's a very simple design. So we're going to touch a little bit on our Income Advantage IUL, which is an accumulation-focused IUL, and then our Life Protection Advantage IUL for sure. And it both follow that very simple design. Oh yeah, so we even, assuming you can see this on the screen, we even won an award, the What You See Is What You Get award, from an industry analyst who does a lot of research on IUL products and tends to be critical of the ones that are unnecessarily complicated. And that's not us. We got the award for that. So in keeping with the simple IUL design, I just mentioned, some companies have multiple indices, and 4 or 5 or 6. They almost have the look and feel of a variable product, but they're not. They're an index product. So we just currently we just have one simple. We have one index, which is the Standard Poor's 500 index, S&P 500. We have 3 interest rate crediting strategies. And you can see some of that information on the slides here. And I'll send these slides to Kathy so that you guys, and that she can send it out to all of you. But you can see that we have the 3 different strategies, the interest crediting strategies, the 100% participation, the higher participation, low cap, and then the lower participation, no cap. And you can see, the amount of flexibility that gives your clients. And you don't have, it's not all or nothing. You can be you can be split between these, between these 3 different strategies. And again, they're available on both of these fully underwritten IUL products. Lower fees is a real philosophy of ours and kind of our battle cry when it comes to product design on our IUL products, and really all of our products. And I don't know, David McKnight, you may have heard of him. He was in personal production for years and a financial planner, I believe. And then now is sort of an industry speaker, author, guru. And I do like this, as you can see in the slide, what it says: remember, whatever you give back to the insurance company in the form of fees is lost and gone forever. What's worse, you not only lose the fees, but you lose the opportunity cost on them as well. So we'll quantify that now a little bit and look at this. And this is all, gladly, it's all really straightforward and really simple. So if you can see in the slide, this is just a really basic scenario: male, age 50, preferred non-tobacco, $1 million face amount. You can see the other parameters there. Paying $20,000 annually for 15 years, total investment of $300,000. And if you look at this, on the chart here, this is the total charges over 20 years. And again, what your client pays and charges is money that doesn't go into the cash value, in the cash value growth. So again, to quantify what I've been talking about, to prove, if you will, what I've been talking about regarding our low fee structure and that kind of pricing philosophy, you can see us there, United of Omaha, at the lowest. Some are close, but others, and not to pick on anybody in particular, but if you look at Lincoln's product or the total charges over 20 years, I mean, that's pretty excessive for sure. And so that's something to be aware of when you're picking an index universal life product. And again, I don't know. Some of you have probably written this product or our products, and maybe a lot of it, but some of you may be brand new to these products. And so just know that the charge structure in ours is extremely competitive. So the life, going a little bit further on Life Protection Advantage IUL, this is designed for what we call protection-focused sales, death benefit-oriented sales. Our other product is more, as I mentioned a few minutes ago, is more accumulation and income focused, more for somebody that might be using the product as a supplemental retirement income vehicle, taking advantage of the tax-deferred growth and the tax-free income. This product still has the tax-free growth and the ability for tax-free income and all the flexibility of the other product, but this is much more of a protection-focused product. So this is going to be much more of a death benefit-driven scenario. I like if I caught this right, Kathy, what you like to refer to it, which descriptively I think is very, very accurate and very descriptive, which is the GIUL, Guaranteed Index Universal Life. Our compliance folks would never let us, put that on a slide. But what we're going to be talking about right here kind of highlights that fact. So this is a product that has all of the flexibility of an index universal life product, but it's got a death benefit guarantee all the way out to age 90. And we'll look at some numbers here to kind of dig down a little bit further. So, we used to have a GUL product, and a simplified issue and fully underwritten, and a lot of other companies did. That marketplace has kind of dried up and gone away for the most part because guaranteed universal life products are very unprofitable for insurance companies. And so what we've done with this product, and by the way, in Kathy, I think you know this, just a few months ago, that second bullet point here would have said death benefit guaranteed to age 85, because it was. We increased the death benefit guarantee on this product to age 90 with no increase in cost. So that's a pretty phenomenal thing. So we'll look at some numbers there. It's really, when you get past the guarantee and on a kind of more current basis, it goes well out past age 90, certainly age 90 is past life expectancy. But so we'll look at some numbers here in a minute. It's got some other cool features, this guaranteed refund option, which gives the client, as you can see there, 6 different opportunities to get 100% of their premiums returned at those years that you can see there. So that's pretty phenomenal, right? So you've got a product so far, and I'm not even done with this, with the benefits or the list of the features here, but super competitively priced, death benefit guaranteed out to age 90, really, really competitive when looking at it on a current basis. Also, this guaranteed refund option rider, which is basically a return of premium, and the client, for whatever reason, if the client didn't like the product or wanted to change products or didn't like the performance of the product, they have these opportunities to to get all their money back. Another really cool thing is we have a long-term care rider available. Now that's at a cost, that's separately underwritten, but it's a true long-term care rider that they don't have to apply for, but if they want to, it will be separately underwritten from the base policy. But what's really cool is no matter what, the chronic illness rider, which is no cost, automatically included, they always get that. And so if they don't qualify for the long-term care rider, they're going to get something similar. A chronic illness rider is not exactly what a long-term care rider is, but the chronic illness rider will provide benefits through an acceleration of death benefit. So you really got everything covered. Excuse me. I think there's a lot of really nice benefits to this product. One moment. So you can see here, let's quantify it a little bit. So these are guaranteed premiums and competitive, and also the projected premiums. And I just noticed this slide needs to be updated because this should say guaranteed to age 90 now, but there wasn't a price increase, so it's going to be the same, but we'll need to change that because, like I said, our guarantee goes to 90. And you can look, one of the companies we compete against quite often in the IUL space is Protective Life. And the numbers just sort of tell the story. I mean, these aren't drastic differences, but we definitely have, it's just a male-female breakdown, age 55 standard non-tobacco. And you can see the pricing advantage that we have there. And then if you look at it more on a current basis, not just the guaranteed basis, you're just paying the no-lapse premium and an assumed rate of 5%. This really tells a great story here. So you can see the difference in the duration of the coverage. We've got for the male, we've got you can see there in the lower right-hand corner, we've got a 22-year advantage over, in this case, Protective Life, and for the female, 7 years. And so I think it's a good story to tell. And then here's some other competitors as well that you can see how we stack up here. Here, at least it says guaranteed premium to guaranteed age 90, so that's accurate. And so you can see the pricing advantage we have to provide that guarantee, right? But these are all the big players in this marketplace. That if you can see my cursor right now, all of these companies, all very good companies, but we've got that pricing advantage to provide that guaranteed age 90. And then what if we looked at it in sort of like a non-guaranteed basis, a couple different ways. And of course you go well beyond the age, at least we do, the age 90 guarantee. So I think it always is helpful to give you perspective and context to show you, kind of put our money where our mouth is, so to speak, and show you where our pricing advantage is. And we get a lot of that pricing competitiveness by having a simple, straightforward product. And again, a simple, straightforward product is a good thing. I mean, it's still a dynamic index universal life product, but it's not, it's not designed and built to be overly confusing to the client and to the writing agent, to all of you. And so the extra features, I guess we've already talked about this, got ahead of myself a little bit, but has the guaranteed refund option. We also have the chronic illness that I just talked about, and then a true long-term care rider. And these are both available. I think the slides repeats itself when we look at the other product, the other fully underwritten IUL product. So that was sort of the lead product that we wanted to talk about. I hit if anybody on this call, and Kathy, obviously to you as well, wants a more in-depth look at this, or running illustrations or going through case studies, things like that, I'm happy to do that for sure. But that is one of our most popular, best-selling products that we have. Certainly, this product is the one that, well, as the slide points out, this is the same. It's not the same product. It's the same index universal life product, but we call it Income Advantage IUL. And this is now going to be more for that accumulation-focused sales. So maybe for a person that's not necessarily looking for just tons of guarantees and long-term guarantees, like I just showed you on the other product, but somebody that might be looking to use this product for its upside potential, cash accumulation, tax-deferred cash accumulation, and the ability to take out income tax-free via policy loan. So let's take a look at this. And here we just jump right into the numbers, and you can see here on the slide, and again, you'll all get, oops, I'm not sure what happened there. You'll all get copies of these slides, but again, pretty straightforward scenario, very similar to a scenario we looked at earlier. And you look at the story here, here we are on top, United of Omaha, and, look at the difference, whether it's, we're not ahead in every cell and every year, but on an average, we've got a really big competitive advantage with our cash values, especially here in the early years, right? Because we don't have all those premium charges and expense loads that just eat up all the cash value. So again, another way of kind of proving where we are in terms of our competitive position within the marketplace on this product, just like we did with the protection-focused product. And then the fee story, kind of a broken record on this, but it's an important part of the story. If you look at this again, here it shows you the total premiums paid, and then the next slide shows you another look at it, which is over 20 years total. So this is total premiums paid versus charges over 20 years. And you can see the different companies out there. And, we've got a good story to tell. And you can see us here, and we're, leading the pack in terms of having, the smallest amount of premiums that go to charges. And just like the quote that I showed you on that slide earlier, I mean, when what is paid in charges is gone, is lost forever. And also the opportunity cost aspect of that. And again, if you look at like John Hancock and Lincoln, those are some pretty hefty charges. Now, those products undoubtedly have other things and features that are attractive, but really where we shine is on the low charge approach, as I've said several times. And then again, this slide does repeat itself because this is, which I think is good, it's a consistency. So just like you had on our Life Protection Advantage IUL, the one we led with, the protection-focused one, just like that, with this one as well, you get that guaranteed refund option, the chronic illness automatically included, that benefit, and then also the long-term care rider on this product as well. So there's so much this product is both of these products are so dynamic. There's so much to talk to your client about. You know, unlike say a term policy, we sell a lot of term. We have great competitive term. You folks probably know that, but there's not a lot of talk about it with that, right? It's a commodity driven market. It's price driven, and you pay a premium, you get a death benefit, and that's it. There's no cash value. There's no flexibility with the product whatsoever. Very appropriate in a lot of circumstances, but I think hopefully what you're seeing, if this is somewhat new to you, these products, is that, wow, there is so much to this product beyond the death benefit and beyond what they're paying in premium when you look at all these different benefits. And so this slide just talks a little bit about the chronic illness rider, which I've talked about, gives you some details as to, the most important thing I'd want you to understand with this is these benefits are all paid by an acceleration of death benefit. And as such, they're 100% income tax free because it's the death benefit, but it's just being accelerated when the client becomes benefit eligible. So it's really nice. And then we have our long-term care rider, which is more of a, we sell a traditional standalone long-term care as well. And this is basically functions exactly like that. But it's a rider on again, both of these policies. And so again, there's just so much, and if they don't, they would be underwritten separately for the long-term care rider, which makes sense. And if they're declined for the long-term care rider, they can still move. Theoretically, there'd be a scenario where they wouldn't be declined for the base policy. They could still move forward with the base policy and automatically have that chronic illness rider, as part of their policy. And then here's just another comparison, just a real, simple scenario with the Life Protection Advantage. So this is now back to the first product we covered, the death benefit-oriented product, the protection-oriented product, protection-focused product. And you can see with the long-term care, let's take a look at how we rank just both the standard and preferred issue classes. And again, we had, obviously I'm biased, but we have a incredible, these are facts here, so it's not a matter of bias. We have a very competitive advantage with our pricing, even when you include the long-term care rider. Okay, so with that, I said we'd go maybe not 30 minutes, and we went about 27 minutes, so that was pretty accurate. But so with that, I want to stop now and take a big sip of water because I'm losing my voice, and may open up to questions. But maybe first, Kathy, I'll kick it back over to you and see if you have any questions, or more importantly, anything you want to add, because you work these cases, and you're a big fan of I'll use your phrase, GIUL. You're a big fan of the GIUL. Is there anything you want to tell the folks? Yeah.
So we get a lot of calls looking for a GUL, and a lot of people know GULs are kind of disappearing off the market face. What's been replacing them is basically a protection builder product on an IUL chassis, which is basically your Protection Advantage IUL plan, which I call a GIUL, Guaranteed Death Benefit to age 90. Running that product on the illustration correctly, normally by the time they're 90, there's cash value really heavy on the non-guarantee side that actually brings that death benefit out to safely to 121, which is great because then it's a good protection plan for your clients. You're living past, the age of age expectancy anyway right now at that time frame. I know there's a lot of people that live beyond that, which is good. My grandma was 103 when she passed away, so I do look at that when I'm running quotes. But knowing that cash value is increasing constantly and it builds, and then you start seeing sometimes an increasing death benefit on that avenue, or at least having that same death benefit guaranteed the rest of your life to age 121. And then the premiums, what I like so much about this plan is comparing your product to any other carrier on a GUL chassis, your premiums actually come in a lot less expensive. So it's comparison-wise, that's why I like this product. And then you're talking to your clients about how they can use the cash value if needed. They can add living benefit riders to this plan. They can get return of premium on this plan. It's just a good fit for most clients. but this is kind of one of those products that a lot of agents don't know about or recognize how to sell it or how to use it. That's how I've been trying to position it here, because it does fit a lot of different needs for most people on that.
Yeah, really well said, Kathy. And when you compare it to the ever-shrinking marketplace for true guaranteed universal life products, you know, they generally had essentially no cash value. So you're, you know,
right.
and you know, so in this situation, and I'm just adding to your point, right, which is with this product, the Income and Life Protection Advantage IUL, you know, you get that guaranteed in age 90, which is well past life expectancy. You get on a current basis, you get to go, you know, well beyond that. But unlike an old school GUL that's gone anyways, but just to compare it, that GUL had no cash. And like you pointed out, this product does have cash that can be used in a multitude of different ways. So yeah, I agree with that.
Correct. We do have a couple different questions. I have Mike asking, is the GRO an add-on cost to the plan?
No, great question. That's automatically included.
Right. I like that plan too, so you can come back and tell your clients, look at this. So if you decide that this is not what you need today, and you've already made it out 20, 25 years, this plan, you can get your full return of premium on it. There's a lot of times where the beneficiary is going to be the spouse, and something may happen to the spouse, or something else has happened along the way where they don't need the benefit. That's a great way for the client to get their money back. Next question from John: how much extra does the long-term care rider cost as a % of the premium?
Yeah, that's a hard one to answer because we'd have to run an illustration, a proposal to really break that out. In other words, it would be based on so many different factors: how the underwriting came in for the base policy, you know, the life insurance, and how the underwriting came in for the long-term care. And then you'd look at that together, and then you'd look at that. I'm just going back to this slide. Yeah, this is just with everything. So that's a good question. This is the base product with the rider, but it doesn't break it out. But if you needed or wanted to look at that, it's something that we could do. We can run an illustration. Kathy and her team as well could run a proposal and break that out. But I don't even want to take a stab at it because in terms of percentages, because it'll vary so much from case by case in the underwriting outcome for both the rider and the base policy and the insured's age and stuff like that. But it's not. Don't think it's a doubling of premium or anything like that. It's there. There is an additional cost, but it's not prohibitive. That's how to answer that.
The nice thing about that, when you're adding that extra rider on there, you're giving them basically one package that contains everything that they may need for their future. You're giving them the death benefit if something happens, that way they're protected, and then you're also giving them those additional rider to actually prevent, you know, having to go to the nursing home and not having any funds to protect themselves against it. And then you're getting both packages all in one. So that's a good option for clients.
Yeah.
We see a lot more of that happening. Clients are actually asking for these type of plans now because they have been on the market for a while and they're seeing that. So please make sure you're talking to your clients about the living benefits and the long-term care riders, because if you're not, you're missing something that they already probably know about from somebody else. I have another question. Go ahead.
Oh, go ahead. Yep. No, go ahead.
Oh, sorry. Okay. Another question from Bruce: are the plans sold in the last 2 years also guaranteed to age 90 years old? They were only to age 85. You guys didn't do anything different with those plans, did you? They were just to age 85, which are still good because they were ran the correct way. Then they should actually run out to age 121. Yep, on that avenue.
Yeah.
But they can call and get an in-force illustration of the policy, correct, through the carrier?
That's what I was just going to say. Again, if you wanted specifics. No, not earlier, not a few minutes ago. I was going to say something about long-term care. But with this, you could get an illustration or in-force illustration and get a very specific and detailed look at that for net, so that's how that would be best explained.
Okay. And I have another question here from Myra. I missed the part where we spoke about the maximum age to acquire the IUL. So I'm thinking 18 to, Dave, or help me on that. Is it 75?
Oh, sorry, I had you on mute. Sorry.
Okay.
Maximum issue age on both. I want to double check this, and I can get the answer to you. It goes out to age 75.
That's what I thought. Okay. And I think that's it for questions. If you have additional questions, give us a holler here, 800-365-8208. The team extension is 607, so you can reach me, Kathy, or Melissa, or Kelly. We're here to help you on that. David, do you have anything else that you want to use to close out?
No, just thanks again for everybody's participation. Great questions. Thanks for your time, and we're here to help. And the best way to learn about these products, in my opinion, is to actually get involved in an actual case or even a sample case. So we're here to help and run illustrations for you, so I can assist. You can, Kathy and I can help you on that, and very much look forward to working with you. And thanks again for your time.
Thanks, everybody. Have a great day. Take care. Bye. Thanks, David.
Thanks. Bye-bye. Thank you. Bye-bye.